Jack Bogle died in January of 2019 at the age of 89. He spent his career building Vanguard into the largest mutual fund company in the world, pioneering the index fund that allowed ordinary investors to participate in the stock market at a fraction of the cost of actively managed funds, and writing extensively about the principles that protect ordinary investors from the financial industry's tendency to extract fees and take risks at the depositor's expense. He called it investor capitalism, when ordinary people own the means of production through broad index funds. And he called the financial industry's fee extraction machine the relentless rules of humble arithmetic. Before his death, Bogle warned repeatedly and specifically about three things that are directly relevant to every American's cash protection strategy in the current environment of April 2026. He warned about the risk of concentration, putting too much with too few institutions. He warned about the illusion of safety in products whose fine print reveals risks the marketing does not emphasize. And he warned about a very specific danger, leaving money in low-yield accounts that destroy purchasing power silently while appearing to be perfectly safe. The Bogle Warning, as the investment community that bears his name in the Bogleheads Forum has crystallized it, is the systematic approach to protecting and positioning cash that Bogle's principles demand in exactly the environment that exists today. 60 banks on the FDIC problem list, $36 billion in unrealized losses still sitting on bank balance sheets, $900 billion in commercial real estate loans maturing this year, one bank already failed in 2026, oil above $100, driving inflation to 3.3%, and placing the Federal Reserve in a policy trap that prevents the rate cuts that would relieve pressure on the bond portfolios that are the source of those unrealized losses. This is what matters. This is what changes the equation. And this is where the Bogle-inspired approach to cash protection becomes not theoretical, but immediate. It starts with understanding what your bank is not telling you about what is happening inside its balance sheet right now. The FDIC's quarterly banking profile for the fourth quarter of 2025, published in February of 2026, contains four numbers that every depositor in America should know, and almost none do. First, 60 banks are currently on the FDIC's problem bank list. These are institutions that have received CAMEL's composite ratings of 4 or 5, indicating financial, operational, or managerial weaknesses that could lead to insolvency. 3 new banks were added to this list in the fourth quarter alone. Second, $36 billion in unrealized losses remain on the books of United States banks as of December 31st of 2025. These are losses that exist right now on bank balance sheets, but are not required to be reported as realized losses because the banks intend, and in most cases will be able, to hold those securities until maturity. Third, one bank has already failed in 2026. Chicago-based Metropolitan Capital Bank and Trust closed its doors on January 30th of 2026 with $261 million in total assets and $212 million in deposits assumed by Detroit-based First Independence Bank. Fourth, $900 billion in commercial real estate loans are maturing across the banking industry this year, with commercial office property delinquency rates exceeding 12% in early 2026, according to the Polymarket analysis of banking system data. These four numbers describe a banking system that is, in the FDIC's own careful language, resilient overall, but facing ongoing weaknesses in certain portfolios. But the truth is, in the Bogle-inspired investors' language, they describe a system where the risks are real, documented, and concentrated, specifically in the institutions and loan categories that the mainstream depositor is least likely to be monitoring. That distinction matters, because the Bogle Warning is not a prediction that all banks will fail. The FDIC itself notes that the problem bank count of 60 represents 1.4% of total banks, which is within the normal range for non-crisis periods of 1 to 2%. The Richmond Federal Reserve Bank published research in April of 2026, confirming that bank failures are almost always preceded by weak fundamentals, bad loans, low capital, and declining earnings, and that deposit insurance has dramatically reduced the frequency and severity of bank-run-driven failures since its introduction in 1933. So no, this is not a panic signal, but it is an information-based repositioning strategy, grounded in the same principles Bogle applied to every aspect of portfolio management. Understand what you own, understand the risks you are bearing, and ensure that the risks you bear are intentional and compensated rather than inadvertent and invisible. And the specific risk that the Bogle Warning addresses is not the risk that your specific bank will fail. The real risk, but most people never frame it this way, is that you are carrying more bank-specific risk than you realize at a yield that does not compensate you for that risk. When alternatives exist that are legally structured to provide materially better protection and materially better yields, that gap between what your bank pays you to bear its risks and what you could earn protecting yourself more effectively is exactly the kind of humble arithmetic that Bogle spent his career teaching ordinary investors to recognize and exploit. Here are the specific facts about the FDIC insurance system that most depositors do not know, and that form the foundation of the Bogle Warning's cash protection strategy. The standard FDIC insurance limit is $250,000 per depositor, per ownership category, per FDIC-insured institution. That phrase, per ownership category, is the most important and least understood phrase in the entire FDIC insurance framework, because it contains the legal mechanism through which a single depositor at a single bank can multiply their effective insurance coverage far beyond the basic $250,000 limit without moving money to a different institution. The ownership categories recognized by the FDIC include single accounts, which cover an individual's deposits up to $250,000. Joint accounts, which cover deposits held by two or more people up to $250,000 per co-owner. Revocable trust accounts, which cover deposits up to $250,000 per eligible beneficiary named in the trust, potentially reaching $1,250,000 or more for a single individual, depending on the number of beneficiaries. Retirement accounts, including IRAs, which are insured separately from other deposits up to $250,000, and payable on death accounts, which operate similarly to revocable trusts and provide up to $250,000 per named beneficiary. This means that a married couple using the full range of ownership categories at a single FDIC-insured institution could potentially protect well over $1 million in deposits under FDIC coverage simply by understanding and correctly structuring their accounts. This is not a loophole. It is not a technicality. It is the designed functioning of the FDIC insurance system as Congress created it. And that is exactly the point. The Bogle Warning teaches you to use the system the way it was designed to be used. If you are hearing this for the first time, the real shock is not that the protection exists. The shock is that so many people leave their cash exposed simply because no one ever explained to them how the framework actually works. But the FDIC framework is only the first layer. The first strategy the Bogle Warning recommends is the use of United States Treasury securities as the safest cash equivalent asset available to any investor in the world. Jack Bogle's investment philosophy was built on the primacy of United States government securities as the foundation of the fixed income allocation in any well-constructed portfolio. The reason is fundamental. Treasury securities are obligations of the United States federal government, backed by the full faith and credit of the United States. And there is no FDIC insurance limit on Treasury securities because they are not deposits. They are direct obligations of the federal government. A Treasury bill, a Treasury note, or a Treasury bond held in a brokerage account does not face a $250,000 insurance cap. It faces the full faith and credit of the United States government, which is simultaneously the issuer of the world's reserve currency, the world's largest economy, and the institution that has never defaulted on a Treasury obligation in its entire history. The specific Bogle Warning application in April of 2026 is this. Short-duration Treasury securities currently yield approximately 3.5 to 3.75% annually, according to current market pricing. The national average savings account rate as of March 16th of 2026 was 0.39%, according to the FDIC's own national rates and rate caps data. That spread is not small. It is not cosmetic. It is the entire story. The difference between 0.39% in a traditional savings account and 3.55% in a short-duration treasury is 3.16 percentage points annually on every dollar you hold. On $100,000, that difference is $3,160 per year in additional income every year, with substantially better safety protection because there is no bank-specific risk and no insurance limit. This is the Bogle humble arithmetic applied to cash management. You are being paid roughly $3,000 per year less than you should be, per $100,000, for every year you hold cash in a traditional savings account rather than in Treasury securities. And in the current environment, where the FDIC problem bank list has 60 institutions on it and $36 billion in unrealized losses remain on bank balance sheets, the bank-specific risk you are bearing in that savings account is higher than it has been since the period immediately following the banking crisis of 2023. That is the warning. Not panic, not drama, arithmetic. And that summa noi, once you see the numbers clearly, the old assumption that idle cash in a low-yield bank account is automatically the safest choice begins to collapse under its own weight. The second strategy is the use of Treasury money market funds as a liquid, high-yield alternative to traditional bank savings accounts. And this is where many ordinary investors get misled, because the distinction between a Treasury money market fund and a bank money market account is one of the most important and least understood differences in personal finance. It is also the distinction that the Bogle Warning most consistently emphasizes because it affects more ordinary investors than almost any other single cash management decision. A bank money market account is a deposit account held at a bank, covered by FDIC insurance up to the standard limits, earning the bank's offered rate, which, as of March of 2026, averaged approximately 1 to 2% at most institutions. A Treasury money market fund, by contrast, is a mutual fund that holds short-term United States Treasury securities and government agency obligations. It is not a deposit account. It is not covered by FDIC insurance. But to law, it is also not subject to bank-specific failure risk in the same way, because the fund's assets are Treasury obligations rather than bank loans to commercial real estate developers or other bank borrowers. The Vanguard Treasury Money Market Fund, which holds primarily short-term Treasury securities, has been one of the most widely recommended cash management tools in the Bogleheads investment community, specifically because it combines the yield of short-term Treasury rates with the daily liquidity of a money market fund. In the current environment, where Treasury yields are around 3.5% and traditional savings accounts yield 0.39%, the Bogle-inspired choice is clear, documented, and available to any investor with a Vanguard or Fidelity brokerage account. The one nuance to understand is important. Money market funds, unlike bank deposits, are not covered by FDIC insurance. They are covered by SIPC protection, which protects against broker-dealer failure rather than fund investment losses. And the specific Treasury money market fund structure means the fund's assets are in Treasury securities rather than in any institution that could fail in the way a bank can. The Bogle Warning teaches you to understand this distinction and to choose the protection mechanism that is appropriate for your specific situation, rather than defaulting to the marketing language of whichever institution has the most convenient branch near your home. The third strategy is deposit spreading across multiple FDIC-insured institutions using brokered certificate of deposit programs. This is the strategy that the Bogleheads community discusses most frequently in the context of exceeding FDIC limits, and it is the strategy that Fidelity, Vanguard, and Charles Schwab have made dramatically more accessible through their brokered CD programs. A brokered CD is a certificate of deposit issued by one bank but held in your brokerage account at a different institution. When you buy a brokered CD through Fidelity or Vanguard, the CD is issued by a specific FDIC-insured bank, carries that bank's FDIC insurance up to the $250,000 limit, and is held in your brokerage account as a security. If you buy brokered CDs from 10 different banks through Fidelity's platform, each CD is separately insured by the FDIC up to $250,000, providing up to $2,500,000 in total FDIC coverage through a single brokerage relationship. This is not a circumvention of the FDIC's intent. It is not some clever workaround hiding in fine print. It is the exact use case for brokered CDs that the FDIC insurance framework was designed to accommodate. And it eliminates the practical challenge of managing relationships with 10 separate banks, because all the CDs are visible and managed in a single brokerage account. In the current environment, where 60 banks are on the FDIC problem list and commercial real estate delinquency rates are exceeding 12% in the office sector, concentration in a single bank carries more risk than it would in a period of uniform banking system health. The brokered CD approach diversifies that risk across multiple institutions while maintaining full FDIC coverage and earning competitive yields in the 3 to 4% range, which far exceeds traditional savings account rates. The fourth strategy is the Vanguard Cash Plus account structure, which the Bogleheads community has extensively analyzed as one of the most accessible, high-yield, high-protection cash management tools available to ordinary investors. Vanguard's Cash Plus account is not a money market fund and is not a traditional savings account. It is a bank sweep product that automatically distributes your cash across a network of program banks, each providing FDIC coverage up to the applicable limits, with combined coverage extending to $1,250,000 for individual accounts and $2,500,000 for joint accounts as of April of 2026. The account's annual percentage yield as of April 1st of 2026 included a temporary boost, bringing the base rate of 3.1% to 3.35% through September 30th of 2026. This is Vanguard's institutional mechanism for accessing the safety of deposit distribution across multiple banks, the yield competitive with short-term Treasury rates, and the liquidity of a checking account, all in a single account structure. The Bogle Warning specifically endorses this type of institutional structure because it is exactly what Bogle's principles prescribe: simplicity, low cost, appropriate protection, and yield that reflects the genuine market rate for the risk being taken, rather than the artificially low rate that traditional banks offer to depositors who are not paying attention. The fifth strategy addresses the specific risk of holding cash in accounts above FDIC limits without awareness of the exposure. The Richmond Fed's April of 2026 research on bank failures confirmed the historical pattern.